So the purpose of fiscal policy is the use of government spending and revenue collection, as taxes, to influence the economy, influence economic growth, achieve full employment, and stable growth. The people involved in fiscal policy include the President of the United States, Congress, and the Secretary of Treasury. The tools for fiscal policy are government spending and taxes. There are two approaches to fiscal policy. There is discretionary policy and automatic policy. Discretionary policy is the deliberate increasing or decreasing of government spending and or taxes in order to return the economy to full employment in response to an economic problem. Automatic policy includes built-in government stabilizers such as unemployment compensations and marginal tax rates to help mitigate the effects of recession and inflation. It takes place without policymakers involving to respond to current economic problems. The limitations of fiscal policy include the difficulty of changing spending levels, predicting the future, delayed results, political pressures, and coordinating fiscal policy. For expansionary policy, taxes are reduced, government spending increases, and it's meant to stimulate the economy in a recessionary gap. For contractionary policy, taxes increase, government spending decreases, and it's meant to control an economy in an inflationary gap.
So now we have monetary policy. Monetary policy is where the Federal Reserve System takes actions to influence the level of real GDP and the rate of inflation in the economy. The people involved with the federal bank are the 7 Board of Governors, the Federal Open Market Committee, 12 federal banks and 25 branches, and several thousand member banks. Some of the tools that the federal bank uses to monitor the money supply is the reserve requirements, which is where banks are required to keep a certain percentage of their customers' deposits. They loan out the rest. The Fed sets this percentage requirement. Another tool they use is the discount rate or the federal funds rate. When banks need to borrow money, they can borrow from each other at a certain interest rate, which is the federal funds rate, or they can borrow from the federal bank with a rate of the discount rate. The federal bank sets the discount rate, but not the federal funds rate. It only influences it. Some limitations to monetary policy is bad timing, inside lag, which is the time it takes to recognize a problem, outside lag, the time it takes to affect, and predicting the business cycle. The last tool that the federal bank uses is open market operations, which is where they buy and sell government securities in order to change the money supply. The Federal Open Market Committee will order the New York Federal Bank to either buy or sell government securities on the open markets. When the economy is in a recession, expansionary policy is used. For monetary policy, reserve requirements are decreased, the discount rate is also decreased, and government securities are bought on the open market. Contractionary policy is used when there is an inflationary gap. For monetary policy, the reserve requirements are increased, the discount rate is also increased, and government securities are sold on the open market.